that means the retail investors, both in the paper markets, in the people who buy GLD and SLV, to have dollar exposure to gold and silver, not necessarily physical gold and silver, but they want to earn more dollars. So they want to use gold and silver as a vehicle to earn more dollars.
Gold's flying, and I thought, wow.
Why would anyone want to buy bonds that are long maturity in a country that has no chance of paying that off whatsoever? I mean, they're choosing inflation over austerity.
In today's episode, 3 experts, Mario, Rafi Farber, and Andy Schectman, explain the recent breakout in gold prices and share their insights and experiences with the world of commodities. These financial experts discuss the current fundamentals of the precious metals sector. If you're into commodities, this video is for you. Remember to watch the video to the end. Like and subscribe to the channel to keep us motivated to do more videos like this, and make sure to check our pinned comment for some massive sign-up bonuses. Let's get into the video.
Very key technical levels from the last almost 4 years, that 2050, 2070. And then last night, my time, or afternoon your time, someone came in and covered probably a lot of paper shorts, and that took the market way up to just below 2150. Yeah, and it's like a line in the sand. Usually that kind of volatility happens when you break such key levels. We had like a triple top there, and we broke through there. A lot of energy, and that's why that happened. But in terms of the volatility in the last 24 hours, yes, it has been volatile. But I looked at someone put out a report. It's based on the last 5 years, and they've got something called the Sharpe ratio, which measures volatility and return of an investment. And gold is like third on the list. It's been the least volatile and the best returns in terms of the Sharpe ratio. So it's actually a very, very stable, if you want to call it, investment. I think the top 2 were like a long and short hedge fund portfolios, or stuff that was really hedged. And Bitcoin, for example, the Sharpe ratio on the ranking, they were way down where compared to gold, even though they have done well. So that's what I would say. And the other thing that I always think, because I've been looking at the gold market since 2002 when I started buying gold, and I could tell right away that there's something fishy, in the paper market. And but what I tell people is, what's the other option? Do you want to get rid of your gold and put it with the banks as fiat currency? It's not even legally yours. It's an unsecured loan. And the other thing is, well, do you really want to have a lot of money in the bank right now? I don't think so, after what happened in March. And we know the latest FDIC numbers weren't very good. The unrealized losses on securities, it's approaching 700 billion. That's how, whenever I get a little bit annoyed about these moves, I always think, what's the alternative? And to me, there isn't. And the other one is, do you want to finance the current administration in the US, or the current administration here in the UK, where they let in 745,000 net illegal immigrants or migrants in 1 year, which is over 1% of the population. So that's the other way to look at it. By keeping fiat currency in the bank, you're financing all these things.
Now, Rafi Farber will explain his views on the precious metal sector and how everything links up with the money markets. Let's get back into the episode.
That fits with the data that I'm seeing, because I'm seeing a lot lower premiums in the physical market. Still a lot higher than average if we go back all the way to 2008, a lot higher. a lot lower than has been recently, let's say since silver squeeze. So we're seeing a lot less interest in the physical market, a lot less interest in the paper market for retail, and a lot more interest in the futures market, in the primary derivative that leads all the other derivatives, like in the ETF. So we're seeing something start, right? And this is probably going to be followed by a financial crisis, which is might bring the spot price down in some kind of crunch, and then the Fed's going to act, and it's going to go boom, just like it did in 2008 and 2020, just a lot faster this time.
What should people be thinking right now? Obviously, we're seeing a lot of volatility in gold and silver, but those holding physical metal, a lot of people aren't there to trade the metal, right? If you're a trader, that's one mindset you can have. But if you're just holding the metal in your own possession, these price fluctuations shouldn't really have much of an impact. But what is your perspective on that?
They shouldn't, as long as you're not leveraged. And this is what I say all the time, like. If you understand what's going on in a broad sense, and the day-to-day movements are disturbing you, just like stop looking for a while. And I have to say this to myself also. Like, I'm also a victim of it. It's axiomatic that gold and silver are the money, and and the dollar is just a derivative of that. So if you own the physical, it's not that easy to pick up your physical stuff, which you have to like take into a car and carry physically, and move to a coin shop and then sell to them. Most people are not going to do this. People who want to trade gold and silver are trading GLD and SLV. It takes a button to click, and that's it, and it's done. And we already know from the numbers that we just discussed that they're not interested anymore. So look. There's going to be one more round of printing, and this is my opinion. And there's going to be one more round because there's going to be one more financial crisis. It's going to be more extreme than 2008. It's going to be more extreme than 2020. And when it happens, the spot price of gold and silver is going to go crazy. I don't know, $2,500, $3,000 in a few nights, overnight. I don't know. I'm just putting out numbers, but it could be that extreme. And when that happens, then only after that are you going to see people in the physical market start to get more interested, right? And it's gonna happen quickly, and then you're gonna see premiums go up and up and up, and you're gonna get calls off the hook, and people affiliated with different gold companies are gonna get calls off the hook. We're looking forward to that, and the danger is like maybe at the point where you say. Someone who sells gold and silver, like, I don't want to sell anymore. I'm just because I don't want the dollars. Then we'll know that we're in the end game. When gold and silver physical stocks are no longer for sale from people like you and me, that'll be it. And so we'll know we're like sort of the operators of the end game in that sense, not to put us in like a pedestal or something, but we're just the functional operators of it because we won't be able to sell anymore. And I think that's next, because I think the next printing round is going to be like something like 10 trillion, $5 to $10 trillion. And what's the difference between 5 and 10 trillion, It's going to be that extreme, and it's going to be that devastating for dollar holders, and it's going to be a big wealth transfer for gold and silver holders. And if it's physical, no one can take it away from you as long as you have it, hidden in a place where the government can't take it from you. And not to encourage anything illegal, but just be smart.
Gold has experienced a notable surge in the final quarter of this year, buoyed by a confluence of factors, including heightened demand for safe haven assets and anticipations of a Federal Reserve rate cut in the upcoming year. The outbreak of the Israel-Hamas conflict in early October initially propelled gold to the vicinity of its previous record of approximately 2,075 oz set in 2020. Despite a subsequent easing of tensions in the Middle East, gold has demonstrated remarkable resilience, capitalizing on a weakening U.S. dollar and a more dovish outlook regarding U.S. interest rates. The precious metal achieved a new record high in early December, and market expectations suggest that prices will likely maintain levels above $2,000 in the coming year amidst the persisting global demand for gold. Crucially, the Federal Reserve's policy stance remains a pivotal determinant for gold prices, with expectations of rate cuts in 2024 providing substantial support to the precious metal's upward trajectory, while gold-backed exchange-traded funds, ETFs, have experienced continuous outflows throughout this year, with a total global outflow of $13 billion and a corresponding 225-ton fall in holdings. A prospective resurgence of investor interest is foreseen in 2024. This anticipated return to net inflows is expected to coincide with the continued ascent of gold prices, especially as U.S. interest rates are predicted to decline. In essence, gold's recent performance underscores its role as a reliable, safe haven asset amid global uncertainties. The intricate interplay of geopolitical events, monetary policy shifts, and investor sentiments contributes to the dynamic landscape of gold markets. As we navigate through these factors, the enduring allure of gold persists, shaping its trajectory as a vital component in diversified investment portfolios. Now, we'll show you more clips of Andy Schectman talking about gold, but first, subscribe and turn on the notifications bell so you don't miss out on the best commodities videos in YouTube. Let's get it.
Of the real value of gold and silver, where the derivative is controlling the price rather than the other way around, I think it will be more of the same. However, the problem is with this whole thing is that, for a very long time, there hasn't been much in the way of any competition in terms of standing for delivery or real drive to buy precious metals. It's interesting that they've gone as high as they have in the face of rising real interest rates. But this is something that I've been talking about for a long time with the de-dollarization and all of the countries that are simultaneously selling treasuries and buying gold, because it's somewhat of a recent phenomenon where entities view government debt as an asset in place of gold. It's kind of going the other way around. But what I'm really getting at is that I expect this to accelerate. And the reason I say that is all the stuff I've talked about like last week, we talked about Saudi Arabia signing a swap agreement with China. And that means that they trade in local currencies to get favorable rates and sidestep the SWIFT, sidestep the dollar. And Saudi Arabia, I've talked a lot about, who has made admissions to doing everything from joining the BRICS, the Belt Road, with all the other OPEC countries on the Belt Road, the Shanghai Cooperation Organization, the New Development Bank. But they told everyone in Davos that they would be open to taking other currencies for oil. Open. Well, the United Arab Emirates, the day before, now right now in the United Arab Emirates, they have a conference with 200 countries there represented on the United Nations summit for climate control, climate concerns, whatever, some woke thing that is in the UAE, and they have 200 countries there represented. And it's no coincidence that the day before, they publicly announced that they're no longer taking dollars for oil. They're the seventh largest oil producer in the world, who just alongside Saudi Arabia and Iran joined the BRICS. And it's interesting. I just want to read one comment. There was, much like this woke stupidity that we keep finding ourselves in, they have a panel there today or yesterday, and it was called the She Changes panel. And because evidently gender identity politics has a lot to do with climate change. And it was the former president of Ireland. Her name's Mary Robinson, and she was talking about how bad fossil fuels were. Well, this whole summit is being presided over by the head of the UAE state-owned oil company. And he says that that if we completely eliminate fossil fuels in the near future, we will take the world back into the caves. And that there is no science out there that says that the phase out of fossil fuel will achieve the UN's global temperature goals. Right through it, right back at her. So what I'm getting at is that this endeavor that the world, the West, is embarking upon, not only is not well thought out, in the respect that the majority of all of the rare earth metals are found in the Eurasian continent and in Indonesia and these OPEC countries. They're the ones who have it all anyway. And also, you have 80 to 85% of the world who's not doing this. And the United Arab Emirates is choosing sides. While it's not as dramatic as Saudi Arabia and the rest of OPEC doing the same thing, it is a massive shot across the bow. And there's no coincidence. You have 200 countries there who witness this, that no, we're not taking dollars for oil anymore. You will wake up one Monday morning to what we saw Sunday night. The only difference is there will be follow through Monday morning where the commercial banks will capitulate. Because the only way you can successfully manipulate a market over a period of time is to push it in the direction that it is going. And being naked short right now, I know you're going to show me how much was dumped onto the market. I know they dumped almost 13 million ounces of paper gold.
Thanks for watching the video till the end. Post in the comment section your opinion on today's show, as it's very important to us to know your honest opinion on the matter. And I see you on the next one.